Firstly, good morning. Good afternoon now, and welcome to you all. I'm Maria Kringle, and I manage our SMSF division here at Saward Dawson. Now, this is the final webinar in our current superannuation series. If you missed our others, they are available on our website. And if you have any questions today, please add them to the Q&A, and we'll come back to you after the session. As this disclaimer says, we'll be providing factual information only, which doesn't take into account your personal circumstances. If you can all make sure you have your microphones switched off, we'll get started. Okay, today we're focusing on an overview of the superannuation contribution options available. These options don't all apply to everyone, but I'm sure there'll be something of interest for each of you. As usual, there is no way of avoiding jargon when it comes to super, but I'll do my best to keep things simple and easy to follow. I intend to start with a simple summary of superannuation in general. Then we'll look in more detail at the types of contributions and a couple of other options that you might like to think about, being super splitting and the government contributions available as well. Okay, so let's get started. Now, our super system aims to help us save for retirement. It's that simple. It's also your money and your retirement. Taking an interest and understanding your options has got to be a good thing. Our system is also compulsory for employees and overall is one of the biggest super schemes in the world. Super has a pool of over 4 trillion, or it did prior to the recent market fluctuations, but things are moving back up again. The income earned on money saved in superannuation is taxed at a lower tax rate, just 15%, which results in your savings growing faster within the super environment than they might in your own personal name. The amounts deposited into superannuation are called contributions. Some of these are concessionally taxed as they enter the super system. Super system. And only 15% tax is paid rather than your marginal tax rate. The trade-off for paying a lower tax rate on earnings is that your super is preserved until you reach retirement age. Being able to maximise your contributions or even pay a little bit extra into super throughout your working life can have a big impact as a result of compounding. There are also a lot of rules and regulations that apply, and they do change regularly, it seems. So it's to your advantage to be informed and keep up to date. Contributions to your super fund can be made by a few different people. Employers are currently required to pay 11.5% super guarantee for all employees, and that's rising to 12% from the 1st of July 2025. Voluntary additional payments can also be made directly from your salary. This is known as salary sacrificing. An agreement is made with your employer prior to earning the money to pay an additional pre-tax amount into super. Rather than paying tax at your marginal tax rate, which might be as high as 45%, your super fund will deduct 15% tax only. Now, not everyone has an employer. Fund members, for example, self-employed people, can make their own contributions. You can also make additional contributions this way, even if you are an employee. Under certain circumstances, the government might also contribute to your super, and we'll discuss this later. Others, such as your spouse and your parents, if you're a minor, can also contribute to your super. Annual caps apply, which limit the amount that is concessionally taxed. It's important to be aware of these caps, as contributing more can result in adverse tax outcomes. Concessional contributions are amounts that are tax deductible either to you or your employer. These amounts are concessionally treated. Instead of paying tax at your marginal tax rate, the tax rate is only 15%. In 2025, concessional contributions of up to $30,000 are taxed at 15% when they enter your super fund. This tax rate applies to everyone, but there is an additional tax payable if by individuals who have incomes higher than $250,000. This is called Division 293 tax, and they pay an additional 15% contributions tax. So basically paying tax at 30%. Non-concessional contributions are made from after-tax money. These contributions are not taxed when they enter the fund, and amounts received above the annual caps, if you were to put more in than those caps, are called excess contributions. As individuals have more than one employer and also, or may have more than one employer and also more than one super fund account, the ATO are responsible for monitoring if excess contributions have been made. The ATO issues excess contribution notices after your individual tax return has been lodged, and there are strict timelines for actioning these notices. Note also that the additional tax is charged to the individual, not the super fund. Although there are options for releasing money from super to pay the additional tax. The concessional contributions, for concessional contributions, the excess amount and associated earnings as calculated by the tax office are taxed at your marginal tax rate, and the excess amount adds to your annual non-concessional cap if it is left in super. You can choose to leave it there or ask for it to be released from super. There is a formal process that must be followed for this via the tax office to request release of super amounts. The reasons you might want to have an excess released are where you need the cash to pay the additional individual tax due, or if you don't want these amounts to add to your non-concessional cap in that year. For non-concessional contributions, the excess doesn't have to be withdrawn from the fund. However, if you don't withdraw them, you will be taxed at 47% on the excess amount. If withdrawn, no tax is payable on the excess. But associated earnings, as calculated by the tax office, are also withdrawn, and these will be taxed at your marginal tax rate, less a credit for the 15% tax on income, which has been paid by the fund. To keep things simple, it's best to avoid exceeding the caps wherever possible. Before we move on to look at more detailed look at the actual contribution rules, you also need to understand how your total super balance impacts on the type of contributions that can be made. You need to know what your total super balance is at the 30th of June of the previous year prior to making any additional contributions. This detail can be found in your MyGov account under the Super tab. It is the total super you hold in all funds and includes super in accumulation phase and pension phase. The types of contributions shown on this slide are all only available to you if your total super balance is under the cap stated here. It's important to note that some of these caps change, so it's always best to review what the cap is in a particular year and what your total super balance is at the 30th of June prior to making the additional contribution. If your total super balance is over 1.9 million at the 30th of June 2024, your non-concessional cap is nil, and you won't be able to make a non-concessional contribution or receive a government contribution in 2025. If your spouse's total super balance is over 1.9 million, at the 30th of June, you won't be able to claim a tax offset for a spouse contribution made in 2025. In 2025, the concessional contribution carry forward is only available to those with a total super balance below 500,000 at the 30th of June 2024. And the work test exemption is only available to those with less than 300,000 at the 30th of June 2024. We'll go into these in more detail later. This table shows the different types of concessional contributions. Remember, these are the ones that they're taxed concessionally, and summarises the eligibility criteria for each. Concessional contributions are not impacted by your total super balance, as you could see from the previous slide. There is also no age limit for superannuation guarantee contributions from your employer. If you keep working as an employee after age 75, your employer is still required to pay super for you. For employer contributions other than super guarantee, there is a maximum age limit of 74. Now, this includes up to the 28th day of the month after the month you reach 75. For example, if your 75th birthday is the 15th of March, final contributions must be made prior to the 28th of April. That can come in handy sometimes. To make a member deductible contribution between the ages of 67 and 74, the work test must be met. This requires that you are gainfully employed for reward for 40 hours in 30 consecutive days during the year. Babysitting grandchildren and volunteer work do not meet this requirement. Also, for member contributions, special documentation is required. What's called a notice of intent to claim a deduction must be lodged with your super fund so they know how to tax the amount you have paid to the fund. And you should have an acknowledgement letter from them confirming this prior to lodging your personal tax return where you'll actually claim that deduction. If this process is not followed, your deduction will be disallowed. Something else that needs to be remembered is that prior to making any additional contribution to super, it's important that you're actually using money you want to save for retirement, as it will be preserved until at least age 60 and maybe even age 65, depending on when you retire. You must also have sufficient taxable income to make claiming the deduction of benefit to you. If your marginal tax rate is less than 15%, a concessional contribution will increase the overall tax you pay and is of no benefit to you. If you want to put money in super in that instance, you'd just use a non-concessional contribution. Now, there are a couple of special options for concessional contributions. The first is the work test exemption. Your fund can accept a member contribution for an extra 12 months after your retirement if your total super balance at 30th of June of the previous year is less than 300,000. And you usually rely on the work test. That means you weren't an employee in the past year and you haven't used the work test exemption before. It's a once-off only option. Obviously, you still need to have sufficient taxable income in that year and the cash to make the contribution. The other special option is the carry forward option. This one is for people with less than 500,000 in super at the 30th of June of the previous year. Any unused concessional contribution cap can be carried forward for 5 years. This effectively increases the individual's cap in the particular year. I've seen this used to great effect where a large capital gain has been made in a particular year, and also where people earn reasonably high salaries or have high income, but while their balance is still under $500,000, they've been able to take advantage of this in a particular year. By paying some of the proceeds of your capital gain into super and claiming a larger tax deduction in the same year as the capital gain, overall tax has been reduced. You can actually review your own situation in regard to the carry forward on your MyGov account under the Super tab. Be very careful to check that the information looks correct to you. If you're in a self-managed super fund, prior year information may not have been reported yet. Other funds need to report by the 31st of October for the prior year. So just make sure it looks right. Okay, there's one other special option available for concessional contributions, and that's the First Home Saver Super Scheme. The timeline for accessing funds were originally very tight for the scheme, but in September 2024, improvements were introduced to improve the flexibility of the scheme. We've seen very few people using this scheme in practice, I have to say, probably because of the administration requirements and rigid timeframes for accessing the money when a purchase is made. All the normal eligibility rules apply, as do normal contribution caps. Only the voluntary contribution made and associated earnings are eligible for release. Now, the benefit of using this scheme is that the income earned on your voluntary contributions and any income generated on those is taxed at 15% rather than your marginal tax rate. So there is still a benefit there. And we'll just move on to non-concessional contributions now. This table shows the different types of non-concessional contributions. Remember, these are the ones from after-tax money that aren't taxed when they go into your super fund. And it summarises the eligibility criteria for each. For the 2025 year, if your super balance was greater than 1.9 million at the 30th of June 24, you are not able to make any non-concessional contributions. Non-concessional contributions are from after-tax money and are not taxed when received into the fund, as I already said. Since 1 July 22, individuals can make non-concessional contributions up to age 74 without meeting a work test. This type of contribution is useful if you want to increase your super toward the end of your working life, when you receive an inheritance or a large amount of cash, and particularly where leaving the money outside super will result in higher income tax being paid at your marginal tax rate. Any income earned on this money in the super fund is taxed at a maximum rate of 15%. The most common non-concessional contributions made are member non-concessional and spouse contributions. If a spouse contribution is made and the receiving spouse's taxable income is under $40,000, the paying spouse can claim a tax offset in their personal tax return. The receiving spouse needs to notify the fund that the contribution is from a spouse. Now, there are also a number of special non-concessional contribution options available. These all fall outside the normal contribution caps, and special forms need to be lodged with your super fund to notify them that they are special. First one we'll look at is downsizer contributions. They not only fall outside the normal non-concessional cap, but there is also no upper age limit. Individuals must be over 55 at the time of the contribution and must have owned the home for more than 10 years. The contribution is a once-only amount and is capped at a maximum of $300,000 for each member of a couple. The actual cash contributed can be from anywhere, and there is no need to actually downsize the home, but just that you have sold a home that you've owned for 10 years. The downsizer contribution must be made within 90 days of settlement of the property and the downsizer form must be provided to the fund either before or at the time of making the contribution. The next one is the CGT small business contributions. These are lifetime caps available for certain proceeds from the sale of assets used in a small business. I don't intend to go through any of these today, as these rules are a subject on their own. But if you have a small business, this is something that you should raise with your business tax advisor to see if you might be eligible to make these contributions. Obviously, there's also the recontribution of the COVID-19 early release amounts, and these amounts can be repaid without affecting your normal non-concessional cap. The timing of all these special purpose non-concessional caps is important to consider, though. If any of these contributions push your total super balance over 1.9 million, you will no longer be able to make non-concessional contributions of any other sort. Now, we mentioned before that the annual non-concessional contribution cap is currently 120,000, but there's another special option that applies to non-concessional contributions, which allows you to bring forward the cap from the next 2 years. For the 2024 year, that should be the 2025 year, if your total super balance at the 30th of June 2024 is less than 1.66 million, you can contribute up to 360,000 in 1 year. Making a non-concessional contribution of even $1 above the normal annual cap automatically triggers what's called the bring forward rule in that year. Triggering that bring forward locks in the contribution cap that applies at that time. For example, if the cap increases in the next year because of indexation, you won't get the benefit of that increase. Since 1 July 22, this bring forward rule is available up to age 74. This can allow individuals who retired a while ago to again make additional contributions to super. It can also allow individuals aged between 65 and 74 to undertake what is called the withdrawal and recontribution strategy, which can reduce tax payable if your super ends up being passed to your adult children when you pass away. We mentioned that more in our nearing retirement and also the other one about post-retirement planning, if you want to know more about that. Spouse contribution splitting isn't really a contribution. It is basically just splitting one person's net of tax contributions and rolling them over to their spouse. Some couples use this option to even up their total super balances, as it is only concessional contributions that can be split. It really needs to be done for a number of years to have any impact. But as discussed already, your total super balance impacts on many contribution options. Being able to reduce one spouse's total super balance may mean that additional contributions can be made by that individual in the future. It can also be used to boost the super balance of a spouse who is out of the workforce for a period, as well as evening up balances between spouses prior to retirement. A superannuation contribution splitting application form needs to be lodged with your super fund to initiate this. All those forms are available on the Tax Office website. Now, right at the beginning of this presentation, I mentioned that the government can also make contributions to your super. If you are a low or middle income earner and make a non-concessional contribution to your superannuation fund, you may be eligible for a co-contribution of up to $500. The maximum amount is payable if you contribute $1,000 and your assessable income is below $45,400. You don't need to do anything other than make a non-concessional contribution during the year. The ATO will calculate any co-contribution that you're eligible for and pay it directly into your super account. Another government contribution is the low income superannuation tax offset. If you earn income up to $37,000, any tax that's been paid on your concessional employer contributions up to a cap of $500 will be paid directly into your super account by the tax office, effectively meaning that you've paid no contributions tax on that money. Now, I know we've covered a lot, and I hope you found something of interest for you or your family. If you have any queries, please add them to the Q&A or contact us directly. Finally, as mentioned earlier, we've also run another couple of super webinars recently. One covered what changes as you near retirement and what opportunities you might have then. And the other looks at post-retirement and considers if the planning is over. These are available on our website if you're interested in looking at the recordings. But obviously, speaking to someone about your own personal circumstances might be a better option to make sure that you make the contributions that will benefit you the most. Thanks again and have a good day.